Good morning. The markets are moving, and boy, are they moving. And so are you from the BizNews studios. This is BizNews Daybreak for Thursday, the 29th of January, 2026. What a month January is turning out to be. I'm Alec Hogg, and here's the context you need to win the day. Another huge move for the rand while we were sleeping. We're starting today below 15 Rand 70 to the US dollar. Reason, the gold price. $200 yesterday when we woke up. Today, $300 higher. That's a 4% boom overnight to a fresh peak of 5,566. We're going to have a lot more on gold in this broadcast for you. But just to let you know that on the JSE, Harmony was up 10%, Goldfields 8%, and Anglo Gold Ashanti 6.5%. In the United States, the U.S. Federal Reserve resisted Trump pressure and held interest rates unchanged. Wall Street was steady in aggregate, but some big price movements for BizNews portfolio favorites Meta, ASML, and Tesla, all three of which reported strong quarterly results last night. Lots more on that coming up, but let's begin with the headlines from Doug Krisner at Bloomberg.
The Fed left interest rates unchanged in a move that was widely expected. Policymakers pointed to improvement in the American economy and the job market. Here is Chair Jay Powell.
The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated.
And as a result of those points, the Fed signaled a more cautious approach to potential future adjustments in interest rates. Now, today's decision comes as the Fed faces pressure from the Trump administration. There is a criminal investigation regarding improvements to the Fed's headquarters and the Supreme Court case over President Trump's attempt to remove Fed Governor Lisa Cook. Well, Powell stressed the importance of Fed independence.
Every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well. And that is to have a separation between, to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used through an election cycle to affect the economy in a way that will be politically worthwhile.
That is Fed Chair Jay Powell. We move to earnings news next. Tesla's profit for the latest quarter beat analyst expectations. Now, this would suggest the company is making progress toward overcoming rising cost and dealing with an end to those U.S. tax incentives for electric vehicles. Later, in a call with analysts, Tesla CEO Elon Musk said the company will discontinue the Model S and X vehicles.
It's time to basically bring the Model S and X programs to an end with an honorable discharge, because we're really moving into a future that is based on autonomy.
That was Tesla CEO Elon Musk. At the same time, Tesla announced plans for artificial intelligence. The company is planning to invest $2 billion into Elon Musk's AI company, xAI. We also heard after the bell from Meta Platforms. The company reported earnings for Q4 above analyst estimates, and Meta raised guidance for the current quarter. Meta said its robust advertising business is making it possible for the company to invest in AI at record levels. We got reaction from John Belton, Managing Director for Growth Portfolios at Gabelli Funds.
Meta's headline numbers are a really interesting reflection of the market's attitude towards this right now, because their CapEx and OpEx guides for 2026 were both way ahead of even some of the higher estimates I'd seen out there.
John Belton there from Gabelli Funds. Shares in Meta were up 9% in late U.S. trading. We also heard from Microsoft. Earnings and revenue for the latest quarter both came in above estimates. However, Microsoft's growth in cloud sales seemed to slow. Here is Microsoft VP and CFO Amy Hood.
In Azure, we expect Q3 revenue growth to be between 37% and 38% in constant currency against a prior year comparable that included significantly accelerating growth rates in both Q3 and Q4. As mentioned earlier, demand continues to exceed supply, and we will need to continue to balance the incoming supply we can allocate here against other priorities.
That is Amy Hood, Microsoft Vice President and CFO. Tomorrow, after the closing bell, we'll get quarterly results from Apple. We have a preview from Bloomberg's Tom Busby.
Apple is poised to deliver its biggest sales quarter ever, thanks in large part to expected blowout sales of its iPhone 17 lineup, especially for the higher-end models. But investors are still concerned about rising costs for components, especially memory chips, and what sales look like in China, which declined just 3 months ago. Bloomberg consensus calls for revenue to jump 11% higher to $138.4 billion, the biggest quarterly growth in 4 years, on earnings per share of $2.68. Tom Busby, Bloomberg Radio.
More on those quarterlies. Let's kick off with ASML.
We got to start with ASML, the Dutch-based company that makes chip equipment. They have this sort of cutting-edge machine that is helping all sorts of companies like Taiwan Semiconductor and Intel. So ASML was up as much as 8%. It's pulled back a little bit. It's up about 4.5%, but it did soar to a record high. And here's the deal. Orders in the fourth quarter blew out expectations. They were at a record high. And this is sort of just, again, fueling the talk about the AI boom and that, you know what, maybe there's something here and we're going to start seeing some money after all this investment. So sort of, gave another boost to the AI trade. And that's what we're seeing today.
And here's some deeper insights now into the numbers from Tesla, Meta, and, well, a stock we no longer hold in our portfolio, Microsoft. And that's from the team at the Bloomberg Market Movers podcast.
I'm Carol Massler along with Tim Stanovic. Let's get to some stocks on the move, and we've got some big movers in the aftermarket. Bloomberg News equities reporter Bailey Lipschultz in the house. We got to talk Tesla.
Yeah, got to talk Tesla. The stock right now up just under 3%. The big news, granted, fourth quarter profit better than expected, despite lower car sales, investing about $2 billion in Elon Musk's XAI startup, one of the competitors, with OpenAI and Anthropic. That does seem to be standing out to investors. Just looking through some of the buy-side folks who put out notes, really calling out, okay, if you're buying into the vision that Tesla is more than a car company, they're getting into robots, what does that mean for XAI? Seemingly this is a step in the right direction, at least according to those investors, despite the fact that under the hood, kind of meh.
Wait. Investing in Elon's AI company?
Investing in his own company.
How'd that happen? I kind of get it, but it's amazing that it's...
He knows people.
That enthusiastic.
He knows people
that
there.
kind of
That's
reaction.
how it happens.
Well, I mean, you think back to Sun City, right? They acquired that company, and it was like, okay...
Solar City. Yeah, his cousin.
Solar City. So it's like, okay, how deep does this go? And if you're an investor who's been buying the Tesla vision for how many years, all he's done is make you money. So it's easy to say, okay, well he sees something you don't.
Check out that Walter Isaacson bio of Elon Musk for the sort of story around the Solar City acquisition. Not everybody was completely happy with that. Let's go.
Many would call him a visionary where he goes. I know. We're racing the clock.
We got to go. Okay, so Meta Platforms.
Meta Platforms right now up 9%, was up more than 10%. Beating expectations, Zuck just basically talking up AI and the possibility for them to drive in the long term. The big thing that does stand out is, okay, well, 2026 spending is going to be more than what Wall Street looked for, but he's actually calling potentially for the peak spending, at least in some units. So it does seem like investors are lapping that up. Again, when you're looking at a company, ticker META, that's $1.7 billion and up 10% post-market, there's got to be something for investors to like, and it does seem like leaning into advertising, expanding their opportunities within engineering, and kind of getting better with AI.
All right, Microsoft.
Down almost 5%, ticker MSFT. The big issues are cloud. So cloud sales growth slowing more than expected. They're ramping up their spending in AI, so getting hit from both ends. If you're Meta, you're spending up on AI, but at least there's a vision for how that kind of pays out.
Hermanus is a man from this windy little town called Yaku. Sorry, other way around. Yaku's from Hermanus. Yaku, we need to talk about your upgrade problem. I don't have an upgrade problem. 2 Audis, an Opel, a Kia, and a Hyundai. It's 5 cars, Yaku. Denial. It's just 12 cars. And we buy cars that make it so much easier for you and convenient to sell your car. You want to try it? Okay, just once. Turn off the cameras. I see how this is addictive. Take 2 of those. WeBuyCars, the easiest way to sell your car by far.
Gold surges catching everyone by surprise, it seems. But is this a flight to safety or just naked speculation? We have the FT's Katie Martin and Rob Armstrong breaking down what they call a heady cocktail of fear and greed driving the metals surge. They ask the hard question, is the dollar losing its shine, or is the market simply cashing in on global anxiety? The full podcast for members only is on BizNews, but here's a highlight.
One of the things that goes some way to explaining this is the changing nature of safe havens, right? It's the stuff that investors buy when they're nervous about things. Now, normally the dollar would do the lion's share of that work in the financial system. So bad stuff happens, people buy dollars. People are getting more nervous about doing that for obvious reasons. So what else do they buy? Now, the other normal safe havens, normal haven currencies are the Japanese yen, which has been doing actually really badly for a variety of other reasons. So that's kind of out of the running. There's the Swiss franc, which has gone absolutely to the moon and is problematic for the central bank there. But it's only so big. There's only so many Swiss francs to go around. So it does mean that some of that pressure gets forced into gold. And I think what's happened here is you've got some of this grand theory about the role of the dollar in the financial system. But what you've also got on top of that is a huge dollop of just outright naked speculation. There's just a lot of people, whether that's like hedge funds or other funds or individuals and retail investors, who cannot get enough of this stuff. They saw what happened to the price of gold last year, and they're saying, yes, please, I'll have a bit of that. So it's almost like a situation where normally the idea is that gold goes up when something bad happens and people are nervous. But right now what you've got is gold and silver are going up based on fear and greed, which is like a really heady cocktail. And it just means it's very difficult to see what stops it.
I'd like to have one point of dissent and one point of clarification to what you said, most of which, 90% of which I agree with. But the point of dissent is you gestured towards a big flight from the dollar as a safe haven. I don't believe that's happening. I just want to put that on the record. I see how you're reading the data. I see the data also. We're going to have to disagree about that. That's point number one. The clarification or the distinction I would like to make is between two kinds of fear. And I agree with you. Gold is kind of like fear in physical form. You know what I mean? But I think you should distinguish, or we should distinguish, between fear of inflation and fear of debasement, which I don't think historically has a very strong relationship with gold. There are decades in which gold underperforms the money supply or the rate of inflation or all this stuff. It's just not a good inflation hedge. But gold does really well when people just generally feel like hell about the state of the world in really miserable moments. Like the 1970s or during the great financial crisis or during a stock market crash, gold does well. So the thesis I find more sympathetic about gold than the debasement thesis is the one you mentioned, which is speculation, line go up. We're in a very speculative market. We're in a very leveraged market. People will chase anything. But number two, I'm more sympathetic to the idea that people are just afraid right now. And when people are afraid about the state of the world, they buy gold.
In all the excitement, it's also time to reflect a little and ask, is this a bubble? And if it is, what's going to happen next? To try and find the answer here, we go back to ask whether the tech bubble of the late 1990s really was a case of irrational exuberance, or was it a case of professional silence? And indeed, are there lessons for us to learn now? Everybody's getting excited about the way that prices are going up, but pretty much any professional you talk to does wave a very large red flag. Are the professionals inside the industry saying, watch out, while those who are marketing the products, of course, are telling them to, don't say too much? Well, Jeremy Grantham is one of the most famous bears. Indeed, there's a book about him called The Story of a Permabear. and he spoke with Merrin Somerset West about being a bear in a bubble and how it's simply bad for business. In this clip, he argues that while the marketing bosses were preaching endless growth in the late 1990s ahead of the tech bubble burst, the analysts crunching the numbers privately agreed that the market was 100% guaranteed to collapse. Some very strong pointers for today, when everyone seems to agree that we have an AI and even a gold stock bubble, but very few are publicly calling it out.
To you, it was very obvious bubble. You went to all these debates, you spoke to all these investment committees, etc. And for everyone else, it didn't seem to be so clear. But in fact, one of the things that you talk about is how really everybody knew, but they couldn't take the career risk or the benchmark risk of accepting the truth.
One of the most important things I ever did, and one of the keys in the book, no one ever takes any interest in, and that is when I was debating the bulls.
Yeah.
I would ask the audience a few questions, and this was the critical one was the annual meeting of the Financial Analyst Society. And it was in Los Angeles, I think, certainly in California. And there was a cast of thousands, 1,500 people or so.
Yeah.
And before I did my debate, I was allowed to go first by Jeremy Siegel, now Dean of Wharton. And I eagerly accepted, and then I played a dirty trick by asking the audience, hands up, who considered themselves full-time professional stock players, institutional stock players, and 400, according to me and my friends counting, about 400 put their hands up. And I said, right, I have two questions, only for you. One, if the current PE, which is 31, comes down to 17 anytime in the next 10 years, will it guarantee a major bear market? And the vote was 100%. They said, yes, it would guarantee. So I said, right, now we get to the jackpot. How many of you think it will come down? And I was so shocked, I had to ask the question 3 times, rephrase it. Only 2 people in the audience of that 400 thought it would not come down to 17. And of course it did.
Yes.
But 398 people in the engine room of the Goldman Sachs's and the JP Morgans and so on, Morgan Stanley's, they believed in data that guaranteed a major bear market in the future. And the people on the podium, however, their bosses, or their marketing bosses, let's put it that way, were saying, Jeremy, let's be serious, don't get so carried away. The market is okay and we'll muddle through. I think that's a fair statement for the top of the market.
Yeah.
And people don't get that. They thought, because they only hear the bosses, they thought that intelligent opinion was that the market would keep going. And in fact, intelligent research opinion, the real experts, would have said, we guarantee a major bubble breaking here.
Interesting.
And no one knew that. And no one cared when I pointed it out.
Yeah.
And in the end, we had over 1,000 people polled who were claiming to be professionals.
Yeah. So while you looked like an outlier with your opinions there in the late 90s, in fact, the engine room agreed with you.
Absolutely. And what we found then and ever since is the obvious fact that it's not a business strategy to be a bear in a bubble.
Similar story to what we hear often from Piet Viljoen. He says, when you start seeing advertising from financial institutions at airports, beware. It's one of the big signs that investing's gone too mainstream and people are bound to start getting hurt. My view on that one is when people start coming up to financial journalists and ask for share tips, then I know, this run is nearly over. Well, you've had a deep insight today, and now you have the edge. For the full interviews and the details behind these stories, head over to BizNews.com. I'm Alec Hogg. Thanks for starting your morning with us. Now go and seize the day.